Welcome to the Deep Dive, the place where we really, get into the weeds on complex financial stories, dense corporate reports, and try to pull out what you really need to know. Today, we are sinking our teeth into something, well, kind of nostalgic, something that really sits right where snack time meets leisure time. J&J Snack Foods Corp. That's JJSF.
Yeah, JJSF. It's the company behind so many of those fun food experiences. Think about being at the movies with an ICE or maybe a ballpark with a super pretzel, even Dippin' Dots, right? They're a real powerhouse in what we call out-of-home snacking, those impulse buys. But, despite these absolutely iconic brands and, frankly, a pristine balance sheet, the stock has been, well, a bit of a puzzle lately.
Right, and that's exactly the puzzle we want to try and solve today.
Right.
Because you look at JJSF's history, their financial stability, it screams steady, predictable performance. But the stock, it's really lagged the market quite badly. Our sources, we're looking at recent investment research, the Q3 2025 earnings call transcripts, detailed financial reports. They paint this picture of, well, significant internal conflict.
Yeah. The conflict is really this huge gap. On one side, you've got the market's pessimism right now, driven by, short-term operational issues, margin pressures. But on the other side, you have this company's long-term durability. They're essentially debt-free, which is amazing, and maybe some hidden growth catalysts. They're debt-free, which sounds great, but they're facing some real pain from input costs and maybe a couple of self-inflicted wounds, especially in their retail segment. So our mission today is really to figure out, is the market's low valuation fair, given these struggles, or is this just short-term noise obscuring some pretty significant underlying value and maybe some big growth potential?
Okay, let's definitely unpack that. We should probably start by looking at the company's core, its DNA, what analysts are calling this fortress balance sheet.
Okay, so J&J Snack Foods. Founded way back in 1971, they've really carved out this niche, not just making food, but kind of supplying the whole experience economy. We're talking over $1.5 billion in annual revenue now, but their key strategy isn't just scale. It's this laser focus on fun foods, the stuff you eat when you're out having a good time, leisure, entertainment.
It's a pretty smart niche, isn't it? I mean, they're not really going head-to-head with, say, the big chip giants in the grocery aisle every single day. They're selling the moment. They're selling that memory, right? Like a summer day at the amusement park or maybe the seventh-inning stretch at a baseball game.
Exactly. They're targeting those high-margin impulse buys, where your decision is driven more by nostalgia or convenience, not so much by checking the price tag. Like if you've already paid, say, $15 for a movie ticket, are you really going to haggle over the price of an ICE? Probably not. And that environment, that lets JJSF capture some really nice margins in those core channels.
And their brand lineup really reflects that focus, that experiential thing. They're the biggest maker of soft pretzels in the U.S. with Super Pretzel. That kind of dominance, you don't just stumble into that.
No, that market leadership is absolutely crucial, especially in that really profitable food service channel. And then look at frozen beverages. They practically own that space with two huge, instantly recognizable brands, ICE, the classic carbonated slush, and SLU Air-Esh Puppy-E, the non-carbonated version. And then, of course, you've got Dippin' Dots, that beaded ice cream. It's become synonymous with something new, something fun. These brands just have so much equity, and you see them everywhere in all those high-traffic places.
Okay, now let's get to that foundation, the thing that makes them stand out, particularly now with interest rates being what they are, this fortress balance sheet. What makes their financial situation so, well, special?
Well, what's really interesting here is just how financially careful they are. It feels almost, old-fashioned maybe. In today's world where so many companies are loaded with debt, as of the end of fiscal 2024, JJSF had zero debt, completely paid off everything, even the debt from buying Dippin' Dots. We're not just talking low debt. It's literally a clean, debt-free balance sheet.
Zero debt. Wow. I mean, that's a huge amount of protection if things go south. But
Right.
let me push back on that a little. In a market where, capital's been relatively cheap for stable companies like them, is having zero debt really strategic prudence? Or is it maybe possibly underusing their capital? Are they being too conservative?
That's a really important question, actually. If you're purely a growth investor focused on maximizing return on equity using leverage, then yeah, you could argue they're leaving some potential returns on the table. But if you're more of a defensive investor looking for stability, for resilience, then this zero debt status is like gold. It's this incredible buffer against economic uncertainty, rising interest rates, commodity price shocks. It means, if a recession hits people's fund money, JJSF doesn't have crushing debt payments forcing them to make painful cuts or threatening their operations.
Okay, so it's a deliberate strategy. They're choosing durability, maybe, over maximizing immediate growth through borrowing.
Exactly. And that philosophy ties directly into how they treat their shareholders, especially with dividends. Their financial stability is what allows for that incredibly consistent 21-year history of dividend growth. They just recently increased the quarterly payout again to $0.80 per share. And that dividend isn't just wishful thinking, it's reliably backed by the cash they generate internally and that huge safety net of liquidity.
And speaking of liquidity, they're not just debt-free. They have actual cash ready to go, right?
Yeah, they've got about $77 million in cash just sitting there. Plus, they have access to a huge $213 million revolving credit facility that they're not even touching right now. So that's nearly $300 million in immediate financial firepower. They could use it for capital projects or maybe more likely for strategic M&A down the line. This fortress balance sheet really transforms JJSF. They're not just a snack company, they're kind of a defensive asset with a lot of built-in options.
All right, so we've got this financially solid company, great brands, but the stock's been hammered. To figure out why, we really need to break it down segment by segment because the story is really different depending on where you look. They split things into three main buckets: food service, retail supermarkets, and frozen beverages. Let's start with the biggest, the most important one, food service. That's about 61% of their revenue.
Right, food service. That's the engine, the core of their out-of-home business model. And what makes it so resilient is how diversified it is. They sell everywhere you can imagine. Major sports stadiums, theme parks, big movie chains, convenience stores, even schools, that lucrative school lunch channel. This spread gives them a sort of natural hedge against volatility in any one area.
Can you give us a concrete example of how that hedge played out recently, say in Q3 2025?
Yeah, Q3 was a perfect example, actually. While maybe some channels, perhaps smaller theme parks or casual dining places, were a bit slow, management pointed out that the entertainment side just roared back. We saw this massive 37% jump year over year in movie box office sales over the summer, driven by those big blockbuster releases. That huge surge in people going to the movies basically offset weakness they might have seen elsewhere.
So the whole experiential economy isn't dead. It's just people are maybe shifting where they spend those leisure dollars.
Precisely. And their core products are doing really well in this channel. Food service sales overall grew a pretty healthy 4.8% in Q3 2025. And that growth was really led by a big 12.8% jump in overall pretzel sales. Their popular Bavarian pretzel varieties did even better, up something like 20%. So that tells you when people are gathering, they're definitely happy to splurge on these specific, fun, indulgent treats.
Okay, so food service sounds strong. Now let's shift to the pain point, because that strong engine seems to be getting dragged down by the retail supermarket segment. This is the stuff you buy to eat at home, only about 14% of revenue, but it's been a huge weight on how people feel about the stock.
Oh, absolutely. It's been a major source of frustration for investors. It reported a pretty sharp 7.1% sales drop in Q3 2025. But the key thing for you, the listener, is to understand why this happened, because it wasn't just one thing. It was two totally separate issues. One was temporary, operational, and the other was more strategic.
Okay, let's start with the operational one, the painful one related to actually making this stuff. Production capacity, right?
Yeah, that's the hangover from that facility fire they had the previous year. This place was really important for making their retail handheld stuff. Things like those pretzel dogs or stuffed snacks you find in the frozen section at the grocery store. Sales in that specific category just plummeted, down a massive 21%. But it wasn't because people suddenly stopped wanting pretzel dogs. It was literally because JJSF couldn't physically make enough to keep the shelves stocked.
So demand was likely still there, but the supply just wasn't. That's actually a positive sign, I guess, if they can fix the supply issue.
And that's the really critical detail the sources highlight. This specific pain point has a clear end date. Management is saying they expect production capacity to be fully back online by the end of calendar 2025. So this looks like temporary operational disruption, not some fundamental collapse in demand for those products.
Okay, that handles the fire issue. But the second problem in retail supermarkets was a strategic choice they made, which, to me, says a lot about how tough the grocery aisle is these days.
Absolutely. The second issue was with their frozen novelty sales, things like frozen fruit bars, maybe Italian ice. Those dropped 8.5%. And that drop happened because JJSF management made a conscious decision to significantly cut back on their promotional spending, fewer coupons, fewer buy one, get one free deals compared to the year before.
Why on earth would they do that? Don't they know the retail grocery game is all about promotions?
Well, they were likely trying to protect their profit margins by spending less on those discounts. But what it really shows is just how incredibly cutthroat the retail grocery aisle is. The second you ease off the promotional gas pedal, shoppers immediately switch. They'll grab a competitor's brand that is running a deal, or maybe just go for the cheaper store brand option. That 14% segment is just hyper competitive, super price sensitive. JJSF found out the hard way, it seems, that you can't just dial back promotions in that environment without losing significant sales volume.
That's a really clear difference. An operational hiccup versus a strategic gamble that didn't quite pay off. Okay, let's move to the third piece, frozen beverages. This is built around ICE and SLOS Puppy E, making up about 25% of revenue. The headline growth looked okay, 6.1%, but the sources flagged this serious mix shift concern.
Yeah, this is a classic example of needing to look under the hood of the revenue number. That 6.1% growth sounds fine, but it was almost entirely driven by this huge 73.4% surge in sales of lower margin machines. What happened was apparently a major convenience store chain decided to upgrade all their equipment across their network. So JJSF ended up selling a ton of expensive but relatively low profit slush machine hardware in that quarter.
Ah, okay, so they were basically acting like an equipment distributor for a little while, not selling their core high-profit syrup products that people actually drank.
Exactly. And you see the core profitability weakness when you isolate the high-margin beverage sales, the actual syrups and mixes. Those core sales actually fell by 1.5%.
Okay, why did the core syrup sales go down, even with food service doing pretty well?
Well, management pointed specifically to a 400 basis point headwind from unfavorable foreign exchange rates. Now, for listeners who don't follow FX daily, a basis point is just 1/100%. So 400 basis points means a 4% negative impact. Basically, the strong U.S. dollar compared to currencies like the Mexican peso or the Canadian dollar, where they do significant business, meant that when they converted those sales back into dollars, they were worth 4% less. So this negative mix shift towards machines, plus the FX pressure, was a big reason the company's overall gross margin actually ticked down a bit, from 33.6% the year before to 33.0% in the quarter.
Okay, so if I'm putting this all together, it sounds like the company's fighting margin pressure on multiple fronts. Higher costs for ingredients, negative currency effects, and an unfavorable sales mix skewed towards lower margin machine sales. No wonder the stock has been struggling.
Yeah, despite those current headwinds, we really do have to acknowledge the underlying success story, especially since the pandemic. Remember how 2020 just crushed the experiential economy? Well, JJSF showed real resilience bouncing back from that. Revenue hit a record $1.57 billion by fiscal 2024. The basic business model is solid. The issues right now seem to be more around cost management and execution.
Let's focus in on that profitability plateau we saw in the latest quarter, Q3 2025, because the headline numbers, when you first glance at them, looked great. Record net sales, $454.3 million, and a 22% jump in reported net earnings. That should have made the stock pop, right?
It should have, but this is where you absolutely have to dig deeper, look past the headlines, especially for one-time items. That reported operating income number, it included a single non-recurring $10.6 million insurance payment related to that facility fire from the prior year. Now, if you pull that insurance check out, which you really have to do to see how the actual business is performing, their adjusted operating income was only up about 1% compared to the year before, just 1%.
1%. Wow. So take away that one-time insurance money, and basically all the revenue growth they got from food service and selling all those machines was essentially wiped out by rising costs and that negative sales mix we talked about.
That's precisely what happened, and it really shows you why the market is so skeptical right now. JJSF seems to be running really hard just to kind of stay in the same place when it comes to repeatable core operating profit. Those input costs, things like chocolate, flour, plus labor costs, plus the expense of getting production capacity back online, they're basically eating up almost all the gains they're making on the top line.
And that flat core profit picture feeds directly into the market negativity, which we'll definitely circle back to when we talk valuation. But even with that stagnation in operating earnings, the company's defensive strength, that fortress balance sheet, is still rock solid, right? Especially when you compare their cash flow to their net income.
Yes. This is where that financial conservatism really pays off and provides some comfort, I think, for shareholders. They consistently generate more cash than their official reported net income suggests. Over the last 12 months, for instance, their cash from operations was about $145 million. That's significantly higher than their reported net income of roughly $84 million over the same period.
Okay, why is that gap so big? And why should someone listening care about that difference?
Well, the gap happens for various technical accounting reasons. depreciation, amortization, sometimes just conservative accounting choices. But the size of that gap reinforces a couple of key things. One, it suggests the quality of their reported earnings is pretty high because the actual cash is flowing in. And two, it shows their underlying operations are robust enough that they aren't scrambling for cash, even with the margin pressure. This strong cash generation is what lets them confidently manage their dividend and investments.
And that cash flow ultimately fuels their free cash flow, which is the money left over for things like investing back in the business, paying dividends, maybe making acquisitions.
Exactly. Their free cash flow over the trailing 12 months was around $66.5 million. And they're pretty conservative about how they use it. Mostly it goes to necessary capital expenditures, reliably funding that growing dividend we mentioned, and making very targeted strategic acquisitions like Dippin' Dots was. They're not out there chasing risky pie-in-the-sky ventures. They seem to be playing a much more disciplined, long-term game.
And that long-term view seems reinforced by the fact that insiders own a lot of the company.
Absolutely. You've got insiders, mostly the founding family and longtime executives, who beneficially own somewhere between 20% and 22% of the company's stock. When management has that much skin in the game, as they say, it usually reinforces financial caution, careful capital allocation, and a focus on building value steadily over many years rather than just trying to juice the stock price quarter to quarter.
Okay, so given this plateau in core profit, management clearly knows they need to do something. They can't just sit back and hope the economy fixes everything. They need some internal levers to pull to expand margins and find new growth. Let's look at their strategy now, starting with this new transformation program.
Right. This seems to be a major internal focus now. A company-wide transformation program they just kicked off. The goal is pretty clear. Drive operational efficiency and find real cost savings. It feels like management's direct answer to that persistent cost inflation we've been talking about. And the first concrete step they announced was just recently, in August 2025. They plan to optimize their manufacturing footprint, basically closing some older, less efficient facilities.
Okay, optimizing the footprint sounds like corporate speak for cutting costs. Is this a direct attack on that margin squeeze? What kind of savings are they actually hoping for?
They're projecting about $15 million in annualized pre-tax cost savings once the whole program is up and running. Now, for a company doing around $450 million in quarterly sales, $15 million a year is pretty significant. If they can actually deliver that, it should give a real boost to their net margins and help them claw back some of the ground they've lost to inflation.
But closing plants, restructuring,
Oh,
it always comes with risks and upfront costs, right?
definitely. This optimization isn't free. Management has already signaled they expect to take somewhere between $12 million and $20 million in short-term restructuring charges, probably spread over fiscal 2025 and 2026. So investors need to brace for a short-term hit to the reported earnings numbers. That's basically the cost of implementing this potential long-term margin improvement. And the risk, as always with these things, is execution. They have to manage these closures and production shifts really smoothly so they don't accidentally disrupt supply to their profitable food service customers. Losing a few key contracts there could easily wipe out those projected $15 million savings.
Okay, let's shift from cost-cutting to growth potential. This is what the investment research seems really excited about, calling it the call option on growth. These quick service restaurant, or QSR, partnership opportunities, this sounds like the big, potentially game-changing upside the market might be ignoring.
Yeah, this is where the argument for being bullish, the contrarian view, really gets interesting. JJSF is apparently running active tests right now with several major, though unnamed, QSR customers. If these tests succeed, it could fundamentally change the size and scale of their business. We're not just talking about selling to individual movie theaters anymore. They're aiming for national distribution deals with massive fast food chains.
Okay, what are the specific products being tested that have this kind of massive potential?
Well, first, they're testing their churro products. The idea is to get them added as a permanent item on the menu. They expect a decision on that one sometime in early calendar 2026. Just think about the potential volume if a major national chain adds churros permanently. That would mean immediate, significant, and ongoing new revenue for JJSF.
Okay, churros. And the second product is maybe their most famous one.
Exactly. It's the ICE frozen beverages. Management described this test, even though they were vague on details, as going extremely well to date.
Yeah.
Now, obviously, they have to be careful about naming the potential partners for competitive reasons, but just the fact that they're testing ICE, which is a high-margin, high-volume product with a large QSR chain, is potentially huge news.
So if either the churro test or the ICE test leads to a national rollout, how does that really change things for JJSF? Why is it considered such a potential game changer?
Well, it instantly takes them from servicing, thousands of individual locations like theaters or stadiums to potentially servicing tens of thousands of locations through a massive established network with existing logistics. It would prove they can scale up production and distribution way beyond what they do now. The sheer volume needed would completely change how you think about their growth potential. And right now, the market seems to be pricing in a very low chance of this actually happening. That's why people are calling it a discounted call option, big potential upside, low current price tag.
Okay, so that's the big long-term potential catalyst. But there's also a clearer, more immediate catalyst coming from fixing that struggling retail segment, right?
Yes, exactly. The more quantifiable fix for the handhelds business. Remember, the root cause of that 21% sales plunge was the lack of production capacity due to the fire. So simply restoring that capacity, which they expect to do by the end of calendar 2025, is forecast to deliver a pretty straightforward, measurable 10% to 20% sales lift just in that specific category during fiscal 2026. This isn't really speculation, it's fixing a known temporary problem with a predictable outcome.
Now, before we get to the risks, we should probably touch on that long-running strategic weakness JJSF seems to have had. This huge shift in consumer preference towards health and wellness.
Yeah, that's a really good point. Their core business is all about indulgence, right? Fun foods. They've historically been a bit slow, maybe, to jump on these powerful market trends towards low sugar, high protein, better for you snacks. And that's a huge area of consumer demand right now, a space where savvy competitors could potentially eat their lunch, so to speak. It's definitely been a weakness.
So are they doing anything now, or are they trying to catch up?
They are starting to. Management mentioned they've got internal development programs working on things like high-protein pretzels and whole grain pretzels. They're also taking some important steps to align with what consumers, especially parents, want, like actively removing artificial colors from their products, particularly the ones they sell in schools. Now, you could argue these are more reactive moves, playing catch-up rather than leading the charge, but it does show that the leadership team recognizes this strategic gap and is trying to adapt to protect their market share, especially in sensitive places like the school channel.
Okay, so we've laid out the solid foundation and these potentially powerful catalysts for growth or recovery. But any investment thesis, especially a contrarian one, has to seriously consider the downsides, the bear case. What are the big external threats that could justify why the stock is valued so low right now?
Well, the biggest external threat is probably just the overall economy and how it affects the average person, the cautious consumer, as they say. JJSF is almost entirely reliant on people spending discretionary money at places like theme parks, stadiums, movie theaters. If high inflation or economic uncertainty makes people cut back sharply on those kinds of outings, JJSF sales will feel it immediately. They're selling treats, impulse buys, not essentials.
And there's also a very specific quantifiable threat you mentioned earlier related to global trade tariffs.
Yes, that's a serious risk because it hits their profit margins directly. Management actually put a number on it. They estimated that a potential 10% tariff on certain raw materials they import could chop about $8 million off their annual profit. That's a direct hit to the bottom line, and it might be really hard for them to pass that full cost increase onto venues or consumers, especially if everyone's already feeling squeezed financially.
Okay, so you got these external threats potentially hitting demand and costs, combining with those internal persistent problems like inflation on things like chocolate and labor.
Yeah.
It sounds like margin pressure could be an ongoing reality for them.
Precisely. If they can't execute perfectly on that cost-saving plan we discussed, and if the consumer stays weak, then their inability to fully pass on those rising input costs will just keep eating away at any revenue growth they manage to achieve. It's a tough spot.
What about internal risks? Risks related specifically to executing that growth strategy we talked about.
Well, the biggest internal risk, as we touched on, is just execution risk around that operational transformation plan. Closing factories, shifting production lines around, that's complicated stuff. If they fumble the transition, it could easily lead to supply disruptions. And if that happens, they risk damaging relationships or even losing contracts in their most profitable area, the food service channel. Losing just a few key accounts there could completely offset that planned $15 million in savings. And the other ongoing risk is simply failing to crack the code in retail. If they just can't figure out how to compete effectively and consistently in that promotion-heavy grocery channel, then that 14% chunk of their business will likely remain this perpetual anchor, just dragging down their overall results.
Which brings us right back to the core puzzle, this valuation disconnect. We have this debt-free company, clear paths to recovery, maybe even huge growth, yet the market seems to have thrown the stock in the penalty box. How can we actually quantify how pessimistic the market is?
You can really see it clearly in their valuation multiples. The market has just dramatically re-rated JJSF downwards. If you look at their enterprise value to EBITDA multiple, that's a common way to measure the total value of the business relative to its operating profit, it has just collapsed. Back in 2021, it was trading at a peak of almost 26 times EBITDA. Today, it's closer to 13 times on a trailing 12-month basis.
Okay, let's break that down for people listening. What does that compression going from almost 26 times down to 13 times actually mean in terms of market sentiment?
It basically means the market today is only willing to pay about half as much for every dollar of JJSF's operating profit as it was just a few years ago. That's a huge signal of pessimism. It suggests the market is pricing in continued margin problems and assigning a very low probability, almost zero, to those big QSR catalysts actually happening.
Okay, that's the market's view, reflected in the price.
Yeah.
What are the Wall Street analysts saying? Is there a disconnect there too?
There is. The general consensus among analysts who cover the stock is a moderate buy. That implies they tend to believe these current headwinds are more temporary than permanent. And the average 12-month price target from these analysts is around $142.50.
Wow, okay. That's a pretty big gap. If the stock is trading around, say, $98 now, and the average target is $142.50, that implies analysts see potential upside of over 40%.
It really highlights just how contrarian this situation is. You've got the market laser-focused on the flat core profits and the struggles in retail, and then you have the analysts who seem to be giving significant weight to those concrete internal catalysts. The measurable $15 million in cost savings, that predictable 10-20% recovery in handheld sales volume once capacity is back, and, crucially, the massive discounted potential upside if they land one of those QSR partnerships.
So, investing at today's prices is essentially a bet. It's a bet that the company's own actions, the cost cuts, the operational fixes, the QSR push, will successfully overcome the current macro gloom and force the market to eventually reevaluate the stock, maybe pushing it back towards its historical valuation multiples. Hashtag outro.
So we've done the deep dive into J&J Snack Foods. If we had to boil down this whole discussion, the knowledge stack, into the absolute key takeaways for someone listening, what would you say are the three defining pillars of JJSF right now?
Yeah, I think I'd frame it around three things that present this interesting kind of duality. First, there's safety. That's defined by the debt-free balance sheet, giving them huge financial flexibility and downside protection. Second, there's the resilient core business, that food service growth driven by the out-of-home experiential economy. That part seems pretty solid. And third, there's a set of high-stakes, near-term internal catalysts, those QSR tests, the cost-saving program that, if they work out, could fundamentally break this current profitability logjam. Safety, resilience, and high-stakes potential.
Okay, so if you, the listener, were going to track this company over the next year or so, trying to see if the bullish case plays out, what are the maybe three key signposts you absolutely need to watch?
Right. Number one, without a doubt, is the outcome of those QSR tests. You've got to keep an ear out for any announcement about a major national rollout for either churros or ICE. That's the potential stock-moving event. Number two, you'd want to track the sales numbers for that handhelds category within the retail segment. Does that 10% to 20% sales lift actually materialize as they say capacity is restored? That would be confirmation. And finally, number three, keep a close eye on their gross margin trends in the upcoming quarterly reports. Is that cost savings program actually starting to win the battle against rising input costs? You need to see that margin stabilizing or improving.
All right, that brings us to our final thought, something for you to chew on maybe. Given that the company's core operational profit was basically flat last quarter, yet their fortress balance sheet means that dividend feels incredibly safe. Does the market's current obsession with growth maybe obscure the possibility that JJSF should perhaps be viewed differently? Not as a high-growth snack company that's failing to grow fast enough, but maybe more like a super stable, defensive, income-generating utility company for the, essential human need to have fun and enjoy leisure time.
That's a really interesting way to frame it, a question of identity. Are they a growth stock just going through a rough patch? Or are they actually a defensive income stock that the market is mispricing because it's looking for explosive growth? I guess the answer really hinges on whether those churros and ICE tests hit big.
Indeed it does. It's this unusual mix of safety and optionality, all wrapped up in the snacks you buy at your local stadium or movie theater.
Fascinating stuff indeed. Well, that's all the time we have for this deep dive into J&J Snack Foods. Thanks for joining us, and we'll catch you next time.